Hi, so I'm going to be talking you through a set of accounts based on FRS 105, also known as micro-entity accounts. Now there's a couple of reasons why accounts would be prepared on this basis. The first one is that they are a wee bit more straightforward, there's less complexity to those accounts, and so they're a bit easier to be understood. The second one is there are fewer disclosures required on these set of accounts. So generally, accounts that are being reported need to consist of mainly a profit and loss account and a balance sheet, and also a number of accounting policies and notes to the accounts. So micro-entity accounts, there's few disclosures and it's more straightforward to follow. The other thing is you have to meet the criteria, or at least two of the three criteria, in order to prepare accounts on this basis. One is that the annual turnover cannot exceed £632,000 for the year. The balance sheet total cannot be more than £316,000, and on average there shouldn't be any more than 10 employees. So as long as two of these three criteria are met, then you are more likely able to prepare accounts on the micro-entity basis. So let's jump in. So this set of accounts has 9 pages, the first one being a cover page and the second a set of contents, which is self-explanatory. The third page is a general company information page, which contains information about who the directors are, the company number, registered office address, and any accountants that have helped to prepare the accounts. This fourth page is the accountant's report, which is basically the report from the accountant that states that the accounts have been prepared on the information and explanations provided by the company directors. We then move on to a profit and loss account, which is a summary of the profit and loss at this stage, explaining the amount of the turnover, which is your sales, any other income, which could include grants, for instance, cost of raw materials and consumables, which is direct costs in order to make your sales, any staff costs, depreciation and other charges, which are essentially your overheads to help run the business. It outlines the profit before taxation, and it has your tax figure as well, and then the net profit at the bottom, hence why this is often called the bottom line. We then have the balance sheet, and this is the part that is reported to Companies House. It is in two halves. We've got assets and liabilities at the top, assets being what the company owns and liabilities being what the company owes. The fixed assets such as equipment, furniture, plant, machinery, land and property, anything basically that is in the company with a lasting value of more than a year. Current assets, on the other hand, tend to be things that are within 1 year. And current assets contain things like the money that's in the bank, any cash in hand, any funds that are still due to be paid to you from your customers are all included in current assets. We have prepayments and accrued income. Prepayments are when a company pays for something before it actually receives it, such as insurance, for instance. You quite often pay for insurance in advance. So prepayments account for these types of cost. And accrued income refers to income that has been earned but hasn't yet been received. So essentially it's money that's owed to the company for services or goods provided but has not yet been paid for. The creditors line includes amounts the company is still to pay for within a year, such as their suppliers and tax. We then have net current assets, which is often known as working capital, and this is basically those current assets less the current liabilities. Add on those fixed assets and you get the total assets less current liabilities figure there. Any provisions for liabilities are shown, along with accruals, which are expenses arising in the year that were only paid for after the year end, and deferred income, which is income collected within the year for goods or services which haven't yet been provided. This is then taken from the total assets less current liabilities figure, giving us the net assets figure from the company, which balances with the capital and reserves figure shown as well. Then the bottom half of the balance sheet contains the notes, also known as the disclosures to the accounts, and in this case it's simply 3 notes. One explaining the general information of the company, the other showing the average number of employees throughout the year, and the last one a breakdown of any director's loans, so what the director has borrowed and repaid within the year. This next page is a continuation of the balance sheet in which a director is required to sign. Only one director is required to sign this, basically acknowledging their responsibilities in line with the Companies Act, but if there are more directors then all of them should have sight of the accounts. For micro-entity accounts, this is the only page that is required for you to sign off. The final 2 pages are the profit and loss account outlined in more detail. This is all the categories of income and expenditure. This is likely to be the most useful page for directors as it shows the profit of the company and it provides a comparison to the prior year. And this is really good for making financial decisions for the future. If you're looking to drill down into the detail of what makes up these figures in the profit and loss account, or the balance sheet for that matter, and if we've prepared the accounts, then your QuickBooks reports will reflect the figures in the accounts, allowing you to get that deeper dive to see the transactions that make up the totals. So that concludes the run through of the micro-entity accounts for the main accounts. What is uploaded to Companies House is simply 3 pages. It is the cover page, the balance sheet, and the declaration page from the directors, and this is what they look like. I hope you found this video useful and feel free to reach out if you need any further information.